Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
And good morning. Welcome in for another edition of Retire Right with Rick Durkee. I am your host, Shane Griffin. Each and every Saturday morning here at 9 o'clock, I have the privilege of sitting down with our local retirement, income planning, and wealth distribution specialist, Rick Durkee, to help you to retire right. Good morning, Rick. Good to see you, sir.
Hey, Shane. Good morning. How are you doing?
I'm doing great. Always great to see you. And now at 9 o'clock, and you look exactly the same as you did when you came in at 9:30 over the past couple of years, which is a good thing.
Well, and hopefully I'm not getting older either, and I don't look any older than I did in 2015.
Well, for that person listening this morning, you look just as young as you pretend to be, so for what it's worth.
And still just as tall, not shrinking.
Right. Well, before we jump to the topic this morning, the year nothing worked, wanted to remind you listening this morning of a couple of things. First of all, if you have questions for Rick and his team, the phone number is 843-735-5065. If you'd like to see a calendar of events, you can check his website, cfpgroup.biz, cfpgroup.biz. If you'd like to listen to past programs of Retire Right with Rick Durkee, you can either visit his site or check the radio station site, 943wsc.com. Search the podcast page, and the programs are there. We typically get the weekend shows up on the podcast page the following Monday, so it's pretty quick. If you missed the program, want to hear it again, have a question about something, you can go back and listen to it at your leisure, and of course, it's absolutely free. So a number of ways to contact Rick and his team at the Coastal Financial Planning Group. And I know, Rick, it's been a busy start to 2016 for you. It
has, Shane. And, I want to remind our listeners, too, oftentimes we'll reference a past show during the current show. And so this is a great way, folks, through the podcast for you to research that show, listen to it on demand when you want to get caught up, so to speak,
absolutely.
And get the information that you need. Also, when you call us this morning, we will call you back this morning. I will talk to you this morning. So definitely leave us a voicemail. And when the hot topic hits your brain and you have a question that you want answered, give us a call at 735-5065.
Topic this morning, the year nothing worked. Lu Wang wrote an article about 2 weeks ago, Rick, titled The Year Nothing Worked. Interesting statistic. It was the worst year for asset allocation since 1937. Now, before we get into the nuts and bolts of this article that Lu Wang wrote, let's talk about what asset allocation is for that person listening this morning that may have no idea what that means.
Well, Shane, it's a theory, okay, and what it has been developed was under the premise that at different times, different financial markets are going to work differently as far as returns and who's going to be a winner, who's going to be a loser. So asset allocation is a method of diversifying yourself amongst different asset classes. Now, the problem with asset allocation is that when we have big drops, when we have big drawdowns in, for example, the U.S. domestic stock market, oftentimes their asset classes are correlated. They're going to do the same thing. Unless you are you need to take asset allocation one step further today, folks. You need to have asset allocation plus you have to have each one of those asset classes each managed separately, so that if one of them is not doing well, that it's going to go risk off. It's going to sit on the sidelines. So there's another step to proper asset allocation today. The idea was simple when it was developed. When one market struggles, it's okay because an investor could jump into another that's thriving. But in 2015, there wasn't another market that was thriving.
The year nothing worked.
That's right. Yeah. It is the title of the article today. So, again, I think the definition of asset allocation is important to understand, that it needs to be fine-tuned, that you need to have each one of these asset classes individually managed now. And if there is no opportunity, then you just have to say, okay, I'm safe. Yeah, maybe I'm making a little bit of money, or I'm flat, or maybe I'm losing a little bit of money because I'm paying a fee, so that when the opportunity arises in one of these asset class for me to get back in, I'm not making that decision as a retail investor. I know I've got somebody that knows what they're doing putting me in at the right time.
Right.
Because when we let investor sentiment get involved with picking these asset classes and picking these sectors and these decisions as to when to be risk off and risk on, history will show that unfortunately retail investors make emotional decisions instead of rational decisions.
Lots of emotions wrapped into those decisions, absolutely.
And let me offer, Shane, I have a great study. I don't have the 2015 study out yet, but I still have the 2014 study. It's a study of investor sentiment, about 11 pages.
Okay.
It's called the Dalbar study. Be happy to email that to anybody that's listening this morning. If you question what your results were from last year and maybe you're thinking maybe I do need to have some professional investment advice here, the Dalbar study will help you to determine whether or not you're making proper financial decisions or not. And you have a process for determining how to do proper asset allocation and also how to manage your investments based on what your plan is of what you want and need the money to do.
Well, after embracing everything from treasuries to high-yield bonds and technology shares amid 7 years of 0% interest rates, investors found themselves with nowhere to run at a time when the Federal Reserve's campaign of stimulus drew to an end. Normally, it isn't like this, is it?
Well, normally it's not. And even in recent history, if we look at the 10-year Treasury, Shane, we're way off the mark as far as what the 10-year Treasury is paying. Clients come to me and they say, gosh, for safety and surety, I can't go to the bank. They're not paying anything.
No.
The banks are tied to the Treasury interest rates. We see our CD rates as low as they are. We, now find ourselves calling the CD the certificate of depreciation because it's not even keeping up with inflation.
Right.
And we have to start calling, money in the safe zone lazy money.
Yeah.
It really is. It's not working as hard as it needs to for us. If we locked in on a 10-year Treasury right now at 2%, give or take a half a point, what happens if interest rates go up in the future and we're locked in and we want to sell that bond? Certainly, we're going to be selling it at a discount because interest rates have gone up now and people don't want to buy that interest rate that's lower than what is paying. But I think the thing that we're seeing right now is that while the depth in losses in equities and commodities is nowhere near as bad as it was in 2008, the correlation of declines highlights the challenge for money managers who are seeking to amplify returns by rotating among assets. This is what we do at the Coastal Financial Planning Group. We rotate amongst these different asset classes, and then we're risk off in asset classes when things are not looking good. Among other things, honestly, it's a recipe for pain amongst some hedge funds, and the industry is heading for some continued volatility in 2016. There's no signs of relief here. So, we're looking at, if we look back 5 years now, 2011 wasn't a real good year in domestic equities and overall markets. There wasn't a lot of opportunity then. 2015 ends up being that, year that nothing worked. And 2016 isn't showing a lot of promise. But the thing is we've got to hang in there with our process to be invested and managed properly so that we can go forward properly, Shane.
You are listening to Retire Right with Rick Durkee. The topic here this morning, the year nothing worked. If you'd like to contact Rick this morning, the phone number 843-735-5065. The website is cfpgroup.biz, cfpgroup.biz. And a reminder, you can listen to past programs for free by visiting his website or also visiting the station website, 943wsc.com. Simply search the podcast page and you'll find all of past programs of Retire Right with Rick Durkee there. Rick, the S&P did not have a great year either, basically flat. It was off about 0.7%. With nothing really going up, exchange-traded funds, or ETFs, that invest in different asset types as a way to diversify risk have struggled too, haven't they?
Well, ETFs have too, Shane, and the purpose of the ETF was the availability to be able to trade intraday versus the mutual fund. And then we saw August come along, And,
oh boy, they got hurt.
ETFs went from a Friday, to a Monday. Everybody's trading the ETFs on Monday, and then we have a little bit of a tech breakdown on, how those are traded and where your trades got placed. So, it just shows you the way that investments are managed nowadays. That it's still, hey, folks, let's go to the basics here. All right. I said this in last week's show. I'll say it again. We're all big boys and girls here. We determine that we're going to take a certain amount of risk. Nobody wants to lose, but you have to keep in mind that you do hold the course. You have a process in place that helps you navigate through these rough times, because you know that you'll be put to safety. You won't lose a lot of money if things drop down 20, 30, 40, 50%. Yeah. But you might lose 10 to 15 if you're in a high-risk category because you want to earn 8.
Right.
You have to understand that with investing, there is going to be loss at times. You want to minimize that loss, but you have to accept that there is going to be some loss, because over that same time period of 5 to 10 to maybe even as long as 15 years, if it takes us 3 to 5 to get over this funk, that you will come out ahead. You're going to have some good times. You're going to have some bad times. It's about holding the bad times to a minimum. It's about managing downside risk and holding that to a minimum, especially if you're retirement-minded, because you can't afford to wait for things to come back and cash out shares when they're worth less. Your money is going to run out faster than it would if you would have been over on the sidelines and cashing out shares at the prior price before they drop down.
Right. And again, going back to something we talked about briefly last week and something we've talked about a lot for someone that is approaching retirement, sequence risk. Something you have to keep in mind in this market is that sequence risk. And if you want to go through that really quickly as a brief recap, we have the time to do that.
Well, sequence risk all depends on what the market does when you start spending your money down. So if you are in a position right now where you are retiring, maybe you retired last year, maybe you're retiring this year, okay, maybe you're going to retire next year, and in this near future that we have some kind of a negative and you didn't scale back your risk and you are already starting to take income off of your investment assets, your retirement assets, your retirement plan assets, your non-qualified assets, whatever they may be, your real estate income, whatever that is. If you are taking money out of it and the value of that investment drops, if it's a equities or a bond or commodities or whatever it is, if it's an ETF like we just talked about, and you're cashing those out for income, you're going to have to cash out more of that because the value has dropped. And then two things happen. Number one, you're taking more out to get the same dollar. And number two, less dollars are there when things turn around and come back. So you're not going to come back as fast either. And so money runs out it runs out faster just based on the sequence of returns versus, let's say, an example where you retired 2010. Okay. 2010 you retire, and then
things are on the upswing, looking good, feeling good.
Things are on the upswing as a whole, and then we have maybe a negative now. Okay. So that sequence of returns means everything in retirement, and mitigating risk and downside risk management becomes imperative in retirement also.
Well, we've talked about asset allocation. We've touched a bit on income allocation, which we will get into a little bit more. We've talked about the ETFs. And again, really the year that nothing worked was what 2015 was. And Rick, on top of all of this, how did the timing of the Fed's first interest rate increases in almost a decade weigh on the markets?
Well, we've seen here in, recent weeks some negative volatility. It may be a little bit of a backlash on that. It may be some people repositioning, some institutional investors repositioning due to interest rates and leveraged assets that are in the market. I would say this, that at least it's, as it was discussed when it started, easing quantitative
I was
easing
just thinking about
coming
QE.
in.
Yep.
Now it's also easing going out. Okay, so
Gotcha.
I guess we've got
Easy come, easy go kind of thing.
Yeah, yeah. I think that this first interest rate increase in almost a decade is going to have some long-term effects, and I think that we're going to see continued. That it'll just be eased back up. But there's some underlying factors that won't allow it to go that fast, that hard. Yeah. And those are certainly another topic for another show. But I think that we need to keep in mind here that we are probably in a rising interest rate environment, and people would normally say, well, that's why the bond asset class isn't working well. Well, it depends on what type of bonds you're invested in, folks. You may not be subject to interest rate risk. You may have been subject to credit and default risk if you were in high-yield corporates in the last 18 months and saw those bonds lose value. So, different bond asset classes work differently at different times too. So it pays to have diversification amongst those different strategies. So, all in all, interest rates, I think we know that they have to come back up. Yeah. But I think they'll ease in. It'll be slow.
Well, let's talk for a moment before we wrap up the program today about the election. The election is coming. History has shown that typically in the year of an election, there is volatility, there is lots of uncertainty. For someone listening this morning, let's throw that on top of the pile. You've got an election coming up, too.
Well, Shane, it just goes to prove, and our subject today was the year nothing worked, 2015.
Yep.
Well, I can give you probably, right off the top of my head, if we had another hour or two, I could give you 5 or 10 examples of the year that it did work for our clients. You know why it did work? Because they have a plan.
A process in place, yeah.
That they have a process in place. They know that they went through a proper process of discovery to learn what they wanted in the future in their retirement. And so they know that if they stick with that plan, and yes, there's going to be good times and bad times during that plan, but if they stick with the plan and they educate themselves as to why they need to stick with the plan, that they're going to come out all right in the long run. Because basically, what are their main concerns in retirement? Number one, that I make sure that my money that I have earmarked to pay me my income lasts as long as I need it to, that I've done proper income allocation. Okay. Number two, that I make sure no financial roadblocks may come along during my retirement that could change this plan, that I'm protected.
Like healthcare.
Healthcare, taxes, inflation, all of those things. And so we have a plan in place that addresses those so that we know that those concerns are protected against. And then number three, that my plan says that, hey, if I run this plan and I run it through the remainder of my life, I'm probably going to have some assets that are left over. That's my desire. I'd like to, conserve this principle and pass on as much as I can to my heirs as my legacy, or my charity as my legacy. And if I do that, then, hey, everything works out real well. And if I know that up front, that I'm going to have that, then I can plan on that accordingly. So having the plan in place is accomplished through the first step of planning, called a 3-step review.
And I wanted to get to that. With the worst year for asset allocation since 1937, with the election, the interest rate hike, what are some good first steps that someone listening this morning can take? It sounds like coming in for an exclusive 3-step review is a pretty good first step, right?
Well, yeah, it is a good step, Shane, and I'd like to start out with a question here for our listener that is retirement-minded this morning that wants to act on this information that they got today. Did you understand that asset allocation needed to be taken one step further? Did you understand that all markets basically didn't work in 2015? And so when you're doing your review with your current source of financial advice this year, do you find that you did lose some money? Do you find that you did gain some money? Did you find that you went through and looked at your objectives as far as what you want to do going throughout your full period of retirement? your full life of retirement that might be 20 or 30 years? Did you review that plan? Did you make sure that it was proper? Did it need any adjustments? This is part of a review process that once you have that plan in place, that you're reviewing those things, and new financial decisions come up where a 3-step review is warranted every time, where you look at how does this decision affect me from a tax standpoint? Questions are asked and answered in that regards. Secondly, how will this decision affect me from an income and distribution planning standpoint? Am I taking this asset, and is it going to be one of my income allocation sources? And thirdly, how will this decision affect me from a risk standpoint? Important to go through that process of discovery. I mentioned income allocation again, Shane. David Gaylor is going to be a guest several times on our show this year. He wrote the book Income Allocation. I had some time in California with him a couple of weeks ago at a conference, and he is going to he's committed that he would assist us on Retire Right here several times to discuss this theory that he has developed of income allocation. Folks, it's no longer about asset allocation,
right,
like we talked about in the show today. Asset allocation needs to be taken steps further, but having the plan in place and making sure that your income plan is developed properly is most important first. I got a great book. I'm willing to share that with any listeners that call in this morning, called Income Allocation by David Gaylor.
It's a great book.
And
easy read, quick read.
100 pages, but it'll make very good sense to you after you read it, and you'll definitely, I believe, want to follow up with a 3-step review after that. All of these educational tools, as we call them, have always been available to our listeners on Retire Right, and we always offer them to anyone that calls in, 735-5065, and certainly our initial consultation always been complimentary for anyone that calls in, 735-5065, and certainly, as Shane mentioned earlier in the show today, visit our calendar of events.
Yeah, lots of stuff coming up.
CFPgroup.biz, and catch up on shows that you've missed in the past on CFPgroup.biz or WSCFM.com.
So again, call in this morning if you'd like a copy of the book by David Gaylor called Income Allocation. As mentioned, a very quick and easy read, 100 pages, easy to understand. Will really give you a lot of insight into what income allocation is, how it differs from asset allocation, and how you should be thinking more in those terms as you move forward into 2016. So if you want a copy of that book for free, no obligation, 843-735-5065, the number to call, 843-735-5065, the number to call. Rick, as always, we're out of time. Great to see you, sir. Thank you for your time, and we'll see you back here next Saturday at 9 o'clock on 94.3.
Thank you, Shane, and thank you to our listener that joined us today that is retirement-minded. Tell somebody else about our show. We're here Saturday mornings at 9 on WSCFM and WSCFM.com.